Hey traders, this is Blake Morrow with Traders Summit. With me on Friday, once again, Jim Welsh of Macro Tides. Jim, welcome back. And I think you're the perfect, by the way, I think you're the perfect guy to break down this crazy week we've seen of just all the central bank activity. Price action's been a little confusing. We've seen the dollar go up, the dollar go down. You're going to talk about gold. You're going to see, talk about equities. Well, welcome back. Glad you're here to break it down for us. How you doing?
Well, what I'm going to do is that introduction when you say you're the perfect guy, I'm going to take that clip and then I'm going to have my wife listen to it over and over again, okay? Just because.
Right.
No, it was a crazy week, you're right. Not just the Fed, but central banks around the world kind of made some changes that I think got people's attention.
Yeah, they did. And so what do you think jumps out now we can go over all the central banks. But what do you think jumps out the most? Because, as soon as the Fed made the announcement they were going to taper, looks like they were pretty hawkish. Although, the dot plots beyond, 2022 look, I don't think there was as many dot plots up there as people were expecting. But regardless, stocks rallied, but, they've given some back here at the end of the week. But really all we are range bound near the highs. But what do you think has jumped out the most to you this week?
Yeah. Well, I think the response by the stock market was basically, hey, we weren't surprised by anything. People had finally gotten to the point they're going to go to 30 billion a month on the taper, 2-3 rate hikes next year, copacetic. When that news came out, the market didn't back off. I think that just led to buying. Oh, it's not going to sell off on that news. I'm going to buy. The other issue this week, and it's always important, this is a quad witch expiration this week. Futures, options, leaps, weekly options, you name it. And I think that has a tendency of really magnifying. And once the S&P started to rally, I think you got the option expiration coming in and playing a role. The fact that the market reversed yesterday, I thought was significant because of what the Bank of England did, ECB did, and the S&P tried to get above 4720 and wasn't able to hold it. So I think yesterday's reversal, Blake, was important.
So let me ask you this then, Jim. So you think now, of all times, now the market, when I say the market, let's just talk about the S&P in broader sense. Do you think right now, finally, the market has gotten the memo, hey, all these central banks are actually tightening monetary policy. It does matter. Is this the time? Is this the time right now? I'm asking you, I want to know, do I short the market or not?
Yeah, I think that has definitely been, a wake-up call and such. Yeah, the Fed did what we expected.
Yeah.
Wait a second, the ECB shifting, the Bank of England is acting with force, if you will, just demonstrative step. And so I think that, wait a second, the whole regime change of central banks being a huge tailwind, that's changing. But we can't overlook what's happening with the Delta variant of COVID, because cases are ramping up and people are looking at Omicron. Oh my goodness, it's 60% or 60 times more infectious or whatever the number is. And they're looking at this compounding and where's that going to lead? So to me, it's like the worst of both worlds. Wait a second. The punch bowl is being drained by central banks at a time when economic uncertainty is climbing. And I think that's why we saw that reversal yesterday in the S&P and the follow through to the downside today.
So, okay, I hear what you're saying. I understand what you're saying, but I also, and I know everybody else, you can probably see my little snowman back here. We're heading into, Santa Claus rally season. So should I just, put all my chips in and get off the table? I mean, what should I be doing here?
Here's the thing. In 2018, the S&P dropped, I think 15 to 18% between the first week of December and Christmas Eve. So the Christmas rally, Santa Claus rally thing, it works a lot of the time, but it's like crossing a street. If you don't look both ways to make sure a car's not coming, you can get run over. This is, to me, a perfect example of one of those times because monetary policy has been a huge tailwind. It's going to be less of a tailwind. And the Omicron thing is going to be an issue in the very short term, as well as just the holiday season, people traveling, getting together. Cases are going to continue to ramp up going into January. So and just technically, the S&P, you talked about a range bound. to me, it was important that the S&P stays above 4,600. The low today, 4,600. I think the odds are starting to shift. We're going to take out 4,600. We failed at getting above 4720, which to me was like, okay, that was the sign that we're headed higher here. I think a retest and a drop below the December 3 low of 44.95, the odds of that have gone up, I think, a fair amount. Now, once this flush, if it does indeed happen, runs its course, I think we're going to get a rally into January, maybe into February.
Okay,
so,
well, let me ask you this. So let me play devil's advocate here, Jim. Let's say 4,600 holds, because as you and I are talking, I know you're looking at me, I'm looking at you, but I'm also looking at the markets. The S&P has really just rallied like 45 points off of the lows. It is triple witching, as you pointed out. How about, let's just say 4,600 holds. Do I get bearish, or do I just, wait for 4,600 to break?
Well, I think two things. If the S&P can get above 4720 and hold it, ideally close above it, then I think that's a very positive sign that the market's going to follow through to the upside. So to me, those are the two trigger points: 4720 on the upside, 4600 below. All
right. Well, thanks for the update and your technical view of the S&P. And like I said, like I was asking, anything that jumped out with the central banks, but, we did have, I thought it was was it 6 or is it 7 central banks that I even follow? Yeah. FOMC, ECB, Bank of England, Banxico, you had Norges Central Bank, you had Swiss National Bank, you had the Bank of Japan. So that's 7. So you had 7 central banks. Anything else jump out at you before we look at what you want to look at?
No, I think that pretty much covers it. The other thing is emerging market central banks have been raising interest rates. Places like Brazil, Mexico, and a number of other countries, they've been ahead of that game for months, but no one pays attention to those central banks. So there is a decided central bank shift in terms of going from extreme accommodation to obviously far less accommodation.
All right, good. Now that the chart that you brought to me today, and it's something we hadn't even talked about just yet, is you want to talk a little bit about gold. And I'm going to pull up your chart here, and let me pull that up right now. And you could see gold as we have it. And gold, is trading above 1,800. And, how do you feel about it? I mean, gold has been subject to just some ongoing selling pressure. I think traders have been focused more on cryptos, less on precious metals. But, here we got gold actually kind of building a base. What do you think? How do you read this?
Well, my take has been for the last couple of weeks that I thought gold would hold 1760 and then subsequently rally to the 1835 level. So what happened in the last 2 days, I think, in terms of the dollar relative to monetary policy, is we saw the dollar bounce initially on the Fed news and then reverse pretty hard and continue to be weak yesterday after the central banks of England and ECB did what they did. So to me, gold has had, as you noted, headwinds from both crypto and stronger dollar. I think there's a potential that crypto is going to drop, Bitcoin is going to drop toward 42,000. And I think the dollar is in fact going to pull back. Maybe it's 2%, 3%, something. But that to me means that some of the downward pressure that those other markets have provided on gold, that's going to lift. And I think the idea that inflation is going to continue to get worse as we get into early next year, the numbers are going to get worse. There's nothing about it that's going to change. And I found it interesting, like just as a little side note, when the CPI came out, I believe last Monday, people, oh yeah, inflation's peaked. And they're going on, it only went up 0.8 month over month in November versus 0.9 October versus September. It's like, are you out of your minds? But people want to believe that. I think inflation will get worse. Gold needs to get above 1835. So you can see the first line where we hit today around 1813. Think we're going to get above that. 1835 is a big one. I think there's a good shot that gold is going to be able to jump over that as well. And then the downtrend line going back to the highs over the last year or so. You know, 1850, 1860, you know, that's the big kahuna, if you will, in the room. So my expectation is, I think the odds now favor at least testing that important trend line, getting above these horizontal resistances, and then we'll just see how and what happens if and when gold trades between 1850 and 1870. And then it needs obviously to close probably above 1875, 1880. And then the next level of resistance is obviously the middle circle that you have just above 1900. But for the first time, I just think sentiment has turned so sour on gold for obvious reasons. It's underperformed for quite a while, that the table is set that I think we could be surprised to the upside over the next 1 to 2 months in terms of gold performing. And if Bitcoin does falter, you know, I think you have the potential here that, you know, money's always looking for, hey, what's moving? And that if we see gold start to perform better, I think that also acts potentially as a magnet for money flow. So this could be, you know, it has the potential of being a fairly dynamic move, but, you know, it's like one step at a time. It needs to bridge each one of these resistance lines.
Well, you know, Jim, I think every gold bug just pretty much, you know, jumped up and down and said, yippee, I hope Jim is right. You know, look, a lot of,
you mean both of them did?
Yeah, but no, there's a lot of them, a lot of gold bugs that, you know, around, and they're bulls, and, you know, people believe that gold's finally that hen's going to come home to roost at some point, and we're going to see a big rally in gold. And, you know, I got to ask you this, Jim, because we had a debate here with some of the currency traders and my colleagues that I trade with about gold and the dollar. Do you see that, you know, very, very strong inverse relationship that most traders like myself, we pay very close attention to? If gold continues to rally, is that going to weigh on the dollar?
No, I think, again, what's happened here is that the euro is rallying because people were surprised by the ECB. I don't think they were expecting them to move, if you will, as quickly as they're going to. And so the euro strengthened. Well, that's 57% of the dollar. So sometimes I think people get so focused on the dollar, they overlook the importance of the other currencies and their impact on the dollar. And it has nothing to do with US economy or Fed or anything else. It's what's going on over there. And we've seen the euro be weak, because the perception was the ECB was going to continue to be accommodative. The virus was getting worse over there during November. And oh my God, you know, that's bad for the euro, and it acted weak. So to me, I think trying to infer too much from some of this stuff. And in terms of gold, to me, the only way to deal with gold is to trade it on an intermediate basis, unless you get some really extreme readings in terms of sentiment and so forth.
Which means more week to week versus month to month or day to day. So you like
some of those people you're talking about, Blake, they're looking years, man. It's going to the moon, Alice, over the next few years or whatever it is.
Right.
They're gold bugs. To me, I'm not in that camp. I think deflation is still the biggest risk. And I've been very vocal since last spring that inflation was going to be higher than expected, last longer than expected. I think that's going to continue into next year. But there are a number of longer term things that to me suggest, and one of them obviously is debt, you know, that deflation continues to be the biggest risk.
Well, I don't like it when you use the D word, Jim, and I don't think anybody, you know, I was excited to talk to you. Now I'm not so excited to talk to you anymore. No, I'm joking about that. But hey, Jim, I want to say, I really love what you do. How do people as traders, how do they find out more about what you and what you do over at Macro Tides?
Go to macrotides.com and you'll see a bunch of information at the website. If you want to get a sample letter or something like that, just write me an email, Jim Welsh, WELSH @gmail.com, and I'll send you either the current weekly technical review, which I do every single Monday, or a monthly Macro Tides, which comes out usually on the first day of a new month.
Awesome, Jim. Well, I want to say, you know, Merry Christmas to you. Happy holidays. We won't see you next week, since next week it'll be the, you know, Christmas Eve. But the following week, I'm going to look to catch up with you, and I'm sure everybody's going to be waiting to hear exactly what you are thinking going into the beginning of 2022. So happy holidays to you and your family. Be safe, be well, and thanks again for joining us today.
My pleasure, Blake, and happy holidays and Merry Christmas to you as well.
Thank you, sir. Have a good one.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.